Hello, you're listening to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist. Welcome to our 57th episode. Today, we have the honor of having with us, all the way from Basel, Switzerland, Dr. Hyun Song Shin, Economic Advisor and Head of Research at the Bank for International Settlements, better known as BIS. Hyun has been holding this position since May 2014, before which he was the Hughes Rogers Professor of Economics at Princeton University. In 2010, on leave from Princeton, he served as senior advisor to the President of Korea, taking a leading role in formulating financial stability policy and developing the agenda for the G20 during Korea's presidency. Now, head of BIS research, we can talk to him about global macro, financial stability, impact of the pandemic, banking sector trends, corporate sector balance sheets, but today we will do none of that. Instead, we will focus on central bank digital currencies, something we follow very closely at DBS and Singapore, and it's an issue in which BIS has taken a leadership role in outlining the use case, best practice, innovation space, and implication for macro policies and for societies in general. With that in mind, Hyun, welcome to Kopi Time.
Thank you, Taimur. It's a great pleasure to join you.
It's our honor. Is a central bank digital currency nothing more than a digital banknote? And if yes, is it at all transformative?
Well, I'm not sure about nothing more, but it's certainly, you can think of CBDCs as a digital form of cash. And the way to think about this is, at the moment, when an ordinary user makes a digital payment, you have to go through a financial intermediary, like a commercial bank. So when you make a payment digitally, what you're doing is transferring a deposit claim on your bank to the receiver's deposit balance at his or her bank. Now, with the CBDC, as you say, it's like digital cash. You can pay someone just as you would by handing over cash, but you can do it digitally using your smartphone or other devices. By virtue of the fact that CBDCs are a claim on the central bank and it's very cash-like, it brings all the advantages that are normally associated with central bank money. For example, it has the property of finality, which means that once you've made the payment is certain and final without leaving things to intermediaries to complete the transaction. There's also a very important symbolic element here as well, because just like cash, CBDCs would also serve, if you like, as a salient marker of the trust in sound money provided by the central bank.
That's right. And speaking of central banks, you scan the globe. What kind of interest in CBDCs do you see among the community of central banks these days?
Well, you can imagine this is a very important topic among central banks right now. The BIS hosts a number of central bank policy committees. A very important standard setter that's based at the BIS is the Committee on Payments and the Market Infrastructures, or CPMI, and it regularly conducts surveys of central banks. And in the last survey, something around 86% of the survey central banks have some kind of research going on at the moment on CBDCs. And as of June, 56 central banks, as far as I know here, this is a number that I have in front of me, have publicly communicated about either their wholesale or retail CBDC projects. And as you know, quite a few central banks, including the People's Bank of China, the Riksbank of Sweden, are now piloting CBDCs. So I think the short answer is there is a lot of interest. And this is a topic that has a lot of momentum, I would say. And I think it's a very, it's a very, good sign of where we are in the current debate, both on the theory, but also on the practice, on the monetary system more broadly.
Okay, so I may be at risk of asking a dumb question, which is why? what kind of payment, settlement, or societal problems that need to be solved that require exploring CBDCs?
Yeah, so I think the way to think about this is, we're in the digital age, and I think the most important property, the most important feature of the digital age is the centrality of data. So in the digital economy, there is a massive amount of data that is generated in the ordinary operation of digital economy. And the centrality of data, both in business models and in data governance and so on, generates a number of very important problems, which I think have emerged that were not perhaps as central as before. And CBDCs really come into their own in this setting. When data becomes so central to the way we conduct business. So, to put it briefly, because of their construction at the core of the system, CBDCs could offer, if you like, a number of advantages that flow from this importance of data. So for example, if you're thinking of setting up a payment system with the public interest in mind, so that means we want something which is efficient, we want something which has low cost for the user, there is a competitive level playing field, and that you're interested in the payment system being inclusive. So you're not going to be excluding people due to their high cost or through not having the right kinds of credentials to join. Then CBDCs really come into their own. Now, at the same time, of course, given the centrality of data, we also need to bear in mind the importance of other safeguards. So, for example, data privacy and data governance rules more generally. While at the same time, we also need to have a system which also enables integrity of the payment system to be maintained, whereby when I say integrity, I mean protection from illicit activities and the system being used to facilitate financial crime. So it's a so in short, what I would say is CBDCs are important because of data, and data has emerged because of the digital economy. And it's less about the technology and more about the economics, I would say, and how you can channel the digital, how you can channel the economic forces in a digital economy in a way that would serve the public interest.
Human, just as a thought experiment, in the middle of the COVID outbreak, say last summer, if there were indeed CBDC facilities available in countries that were being afflicted by the pandemic, what kind of gains would we have seen in terms of distributive policies or policy action?
Yeah, I think this is a very good question and an entry into the point that I raised earlier about the public interest. So what could we have done with CBDCs? Well, I think the answer is the technology as such is probably secondary, but the way that you design the payment system with the public interest in mind is more important. And I think so let me just put it in very broad terms, and I'll get to some details. So I think the proposition that I put on the table is it's much more important that we bear in mind the architecture rather than the technology. But the technology will enable architecture which is more versatile. So let me give you a specific example. And this is something that you raised just now, which is during the pandemic, we have a sudden stop of economic activity. There is financial stress because of a stop in the cash flows of many businesses, and there are households that are seeing hardship and so on. Now, one way you can deal with this is to infuse fiscal transfers directly to businesses and households. So one part of that could be just direct transfers, a fiscal transfer, if you like. They could also be guaranteed loans and so on. Now, if you have a payment system that has a fairly complete record of the users in the system, if everyone has a bank account and you have a good record of the participants in the economy through the payment system, you could, once there is a political will to do this, you could quite easily make fiscal transfers through the banking system. So, one example I would put here, I think Singapore was the case, but in many countries, when the banking system itself is pretty well established and you have a very inclusive payment system, you can make those transfers directly through people's bank accounts. You have a good record of the users from the banking system itself. You can use that for the public policy purposes, and so it doesn't really need a CBDC as such to really put that into effect. So Korea was an example where you could, once there was the political will to do this, you could actually put it into practice in a matter of days. Now, what you can also say at the same time is if you had a retail CBDC as well, it would be like having the same kind of architecture, but on a much firmer footing. And so there are things you could do on that platform that even the well-functioning banking system, retail fast payment system could not have done. And so I think that would be, one way to think about this. Now, the important thing is, just to reiterate, that it's about the economics and the public policy-oriented goals of the payment system, rather than the technology. Because the technology is pretty neutral as to the outcome, in that, the same technology that could lead to this virtuous circle of greater inclusion, lower costs, better innovation, could equally, in less favorable circumstances, lead to the opposite outcome. It could lead to a much less favorable loop, a feedback loop of walled gardens, a greater shielding from competition, greater data hoarding, and entrenchment of incumbents. So it's less about the technology and much more about the architecture, I would say.
Absolutely. And I want to talk about some of those things a little later, but since we are doing a thought experiment, indulge me for another moment, please, Hyun. Liquidity trap is one area where, you issue a lot of banknotes, you carry out asset purchases, but they just end up as balances in the central bank because banks don't have the confidence to lend, or even if people want to, people have the cash, they don't have the confidence to spend, savings rate jump. So the ultimate time bomb helicopter money, I issue CBDCs that expire in a week, which forces people to spend. That's something that no cash or anything else can do, right?
Yes, there are things you could do with CBDCs that you could not do in the conventional banking system. And what you've described is a version of what has been called programmable money. Now, in a sense, the term programmable money is a bit of an oxymoron, because the nature of money is of something which is immutable, something which is not informationally sensitive. In the economics literature, liquidity and moneyness has to do with the fact that it is non-contingent. Programmable money, you could think about that as a kind of a voucher. It's a claim that has certain contingencies built into it. So you can do that, but I wouldn't pin the rationale for CBDCs on merely its programmability. I think those are kind of additional features that you could build on top. But I think the much more important point is that CBDCs are if you like, another incarnation of the classical notion of money, which is as a non-contingent claim. It's something which does not change in value because of certain circumstances in the economy. It is the promise it is a foundational promise, if you like, from which all other promises in the economy then follow. So yes, we can talk about programmable money, but I would think of it more as vouchers rather than money. And we can do various clever things on top, but I would think those are pretty secondary.
Great. So far we've talked about payments in the domestic setting. I want to sort of switch a little bit toward the cross-border aspect. Earlier this year, I think it was in March, there was a BIS working paper, and I think it began with cross-border payments are inefficient, and technology could play a role in making them better. One means could be through interoperating central bank digital currencies, CBDCs, forming multi-CBDC or MCBDC arrangements. So if you would, help us unpack some of the notions embedded in those two sentences. First, how big are cross-border payments, and how do we measure the degree of inefficiency in this area?
Yeah, so that's so this is I mean, you've raised a very important policy issue. It's one of the top policy questions in the G20, for example, in various multilateral settings. I think the first thing to say is we've so far talked about retail payments. It's for ordinary users, household, small businesses. There is, of course, a much larger volume payment system among financial intermediaries, and so the first thing would be to distinguish, if you like, the retail CBDC discussion from the wholesale CBDC discussion, which is about the payments between financial institutions, which tend to be, in face values, much larger than the retail payments. So there is a discussion on multi CBDC arrangements in the wholesale setting. So, for example, you may have seen this week that the BIS Innovation Hub announced the Jura project, which is this a joint project between the Central Bank of France, the Banque de France, with the Central Bank of Switzerland, the Swiss National Bank, and the BIS Innovation Hub is also part of that, together with a private sector consortium. And there, the idea is, can we link the payments across borders and across currencies? Because Switzerland uses Swiss francs, France uses euros, and can we think of linking the payments between the financial systems of Switzerland and France using a CBDC architecture? And there are similar projects going on in Asia. There was an earlier announcement, which I'm sure you've seen, of the so-called CBDC bridge between the Hong Kong Monetary Authority and the Bank of Thailand, which is now sort of expanded to include China and the United Arab Emirates. That is also a wholesale CBDC project. So there are projects like this going on, and there the main advantage is that because we're talking about financial institutions, we have fewer players that are involved. The issues to do with data privacy and invasion of personal data, that kind of thing, that is less of an issue. And because these are all regulated institutions, we have a much more direct way of just extending the current system, which is already digital. I mean, the wholesale payment system is already digital in that banks have an account at the central bank, and the settlement is done digitally. But by bringing in a CBDC in that context, you can bring in additional features like the fact that you don't need to wait for settlement to take place. You can have an immediate settlement. So you can have, for example, what's called a payment versus delivery type of setting, where in the context of a securities transaction, you can have an immediate settlement without having a separate process which takes some time, which brings in operational risks and so on. And in the cross-currency setting, we have the payment versus payment idea, where you can have an immediate transaction across currencies without necessarily having this awkward gap where you have some settlement lag. So there are these additional advantages, which somewhat hark back to what we discussed just now on the programmability. So there are ways of building in these automatic features on top of the system. Now, those are wholesale systems, and so they are not something that ordinary users would necessarily notice. So even if they are rolled out, what's really, I think, a much more ambitious project is what's going on, for example, in the Financial Stability Board and in the G20, which is about how do we improve the retail payment system. So this is about ordinary users, about remittances, so workers sending money back home, and tourism, for example, tourism expenditures. Now, the figure that we should have in mind is, just before the pandemic, we had something around, so in the whole of 2019, we're something like $720 billion in remittances cross border. That sounds like a big number, but it's probably smaller than it could be, because this is a system which has a lot of frictions. It's high cost. It's about access, and if you compare that with tourism, so tourism was something in the order of double that, 1.5 trillion. So tourism expenditure in 2019 is around 1.5 trillion. So even compared to tourism expenditures, remittances were fairly small. And so I think this is the area where there's probably more scope. But this is also the area where the challenges are much greater, because if you want to extend a retail CBDC into a cross-border context, I mean, there are lots of both technical issues, but less technical, but more policy issues. So, for example, if you want to extend the retail CBDC abroad, how do you manage the ledger? How do you manage the record keeping that actually makes the retail CBDC work? Because a retail CBDC is, in essence, a digital ledger of who has made a transfer to whom, and therefore who owns what balances at what time. Now, if you want to extend that to the cross-border context, you need to have some way of keeping track of what people abroad are doing. And so issues like digital ID, how do you operationalize a cross-border digital ID? Can we even think about a supranational ID? So those are really very, very high-level questions. It's, I think, fair to say that although these challenges are very large, there are ways of circumventing, some of the, there are ways of overcoming, I would say, some of the key challenges. And this is an area where we need to work much harder, because it is something that needs a lot, a lot more thought. So in short, so this has been a very long answer, but in short, for wholesale CBDCs, there's been great progress. And I think from the point of view of a commercial bank, and I'm sure that you've been following this very closely, for wholesale settlement, for cross-currency, for securities settlement, there's been a great deal of progress. I think we have a pretty clear view, I would say, of how these systems would work. There's a great deal of continuity with the work that's already been done. It's more of an evolution, because CLS is something that's already there, and it's a well-established piece of infrastructure, 20 years old. And these new infrastructures are going to be just building on that. Retail CBDCs, that's a whole different matter. And domestic retail CBDCs present challenges to do with privacy, digital ID, and so on. In the cross-border context, there are some really very difficult policy questions.
Right. So one thing that we have been looking with some degree of interest in our part of the world is that Bakeng scheme that Central Bank of Cambodia has come up with, precisely to help Cambodian workers in Thailand and elsewhere to send money back home. And they have gotten in touch with a Japanese DLT company to use that distributed ledger to create a trail so that workers living in Thailand can send money home and be sort of secure in the trail with which the money is going. And of course, the transaction costs in theory will be substantially lower. But you're right, this is early days, lots going on. So Hyun, you've already touched upon some of the potential frictions and operational challenges. From a theoretical perspective, share with us the ideal design feature. I mean, how would you design like a perfect CBDC?
Yeah, I'm not sure that there is a perfect one. I think the way that one would go about doing this is there are some things that we cannot really change, or we shouldn't try to change. So, for example, if we have sovereign countries, and so the sovereign countries will have their own data frameworks. They will have their own approach to how to think about the linking of administrative data sets and so on. There are different philosophies and different political imperatives, if you like. So there are some things which are just features that we have to take as given. And the question is, when we take those features as given, and those are, if you like, beyond the technical design elements, what are the design features that we could that would put in place that would maximize that would promote the public good in a way that is going to respect both of those, both the underlying circumstances that we cannot change, but also tackle the frictions that are much more amenable. Now, I think one issue is so there's a set of issues which are technical. You mentioned Bakun coin, which I think is a very important development. It's been a couple of years actually when since Bakun coin was launched, and I've been following it very closely, obviously. So there are technical issues. For example, should we use a distributed ledger approach, or is a centralized ledger approach more appropriate? And different jurisdictions will follow, different paths. In China, of course, it's more the centralized ledger approach, which has, sort of some technical advantages which have to do with, greater processing capacity, and there are things that you can also do with a centralized system, which makes it easier to link to the current two-tier system, and so on. So there are sort of number of technical issues which I think we can tackle, and there I think the circumstances in each jurisdiction will dictate how which way you would go. I think the much more important and more difficult issues are the ones that have to do with policy. So I've already raised one issue which has to do with digital ID. So one fork in the road when we design CBDCs is, do we want to go down the route of a digital ID-based, account-based system where membership of the network is granted by virtue of the fact that you are that you have a digital ID in the system, and you're granted accounts in a financial intermediary whereby you become a member of that network? Or do we go down the route of a token-based system, like Bitcoin, where you are a member of the network by virtue of the fact that you have a private key to accessing your address in the network, in the blockchain. So so in the case of Bitcoin, you have a private key, that's your address, but you can mask your true identity behind that private key. Now, I think there is pretty broad consensus, I would say, but it's not universal, especially among the crypto crowd. But I think there's pretty broad progress that if we want to improve the current system, it's almost certainly going to be the case that we will need to go down an account-based system with a verified digital ID. It's just I think just infeasible to think that we can build a whole system around something as elaborate and something as awkwardly something as awkward to use as a kind of private key-based a pseudonymous system. But once we go down the digital ID route, we have to think about how do we link the digital ID systems across jurisdictions. And here, I think this goes back to the policy question. This is not about the technology. It's about sovereignty. It's about the will of the people, if you like, because I think that the idea that a foreign entity would have access to the digital ID in your jurisdiction, I think that would be a very high hurdle to actually cross. So if we want to link CBDC systems across borders, there would have to be a way of respecting each other's sovereignty while allowing each of these of the jurisdictions to make use of the ID systems in the other jurisdictions. And I think here cross-border cooperation is going to be very important. And there are ways of doing this. So, one principle that I think is very important here is we can link payment systems without needing to have a supranational ID infrastructure. So there's no one single entity that is the all-seeing eye over everything. We can actually each have a piece of the jigsaw puzzle, and think of it like the jigsaw puzzle principle. Each entity has a piece of the jigsaw puzzle, so no one actually has the full view. It's only the individual that has the full view over his or her personal details. But each party has a slice of that. But there are ways of linking each of these aspects or slivers, if you like, and making the cross-border transactions operational. So so this is where we need to draw on cryptography. So it's the same kind of principles that power cryptocurrencies. The whole point of cryptocurrencies is that we can use these digital signatures that come from the private keys to validate transactions. You can use the same kind of technology, but in the current system with digital IDs that mask most of the details except for the ones that are absolutely essential for that piece of the transaction. And this is something that's already in place in many of the retail systems, where if you have an API in the retail payment system, you can open the app of one bank and check the balances in the other bank, and you can do that because when you log on to the app of one bank, you can send messages to the other bank that authenticate the fact that you are the person that you claim to be. But the other bank doesn't, divulge everything to Bank A. The other bank would only divulge the absolutely essential pieces. So, it will tell you your balances, but not, for example, your address or your payment record and so on. So the technology is not that special. It's already there, and what the CBDCs would do is just make this more seamless. And I guess it would be something that would just take what's going on right now, but make it technically smoother and more efficient. So sorry for the very long answer, but I think that's this needed to be said.
Great. Okay, so moving on from the architecture issue to the issue of exchange rates. We live in a world of currency trading, FX rates being quoted by dealers on a second-by-second basis. How would that be impacted by an MCBDC type arrangement? And would it actually make things more stable?
Yes, I think this goes back to our previous conversation about programmability. So at the moment, the whole intermediation system is built on the idea that a payment is made when you debit the account of the sender and you credit the account of the receiver. And if the receiver is in another jurisdiction and that uses another currency, you need the whole chain of intermediaries, to make that transfer, to make that work. If you have a CBDC, potentially what you can do is to use its functionality to have an immediate transfer, payment versus payment, so to speak, in the jargon, transfer. Where you can, debit the account of the sender and credit the account of the receiver, instantaneously. Now, for that to happen, you need, if you like, the infrastructure that not only allows CBDC use in each jurisdiction, you need also some infrastructure that connects the two CBDC systems.
Right. And to the FX market, because at the end of the day, you would need
and to the FX market. So you would need, so if you like, that infrastructure would need to, have the capacity to have a kind of instantaneous transaction across currencies, as well as the transfer across accounts, across the jurisdiction. So there are two dimensions. There's the cross-jurisdictional dimension, if you like, the cross-border dimension, as well as the cross-currency dimension.
That's right. Global financial transactions are dominated by the US dollar, used widely for payments, invoicing, goods and financial assets pricing, and so on. Do you see the proliferation of CBDCs changing that in any way?
I think, perhaps over the very long run, but I think it's important to bear in mind that the payment system doesn't, float in a vacuum, float separately from the underlying economic transactions. The role of the dollar, and in fact, the role of any international currency, is really predicated on the needs of the users. So, before the dollar, it was pound sterling, or even gold, even before then. And there, the currency becomes international because users demand that currency for the transactions. It has to do with trade. It has to do with the certainty of the settlement. It has to do with the legal framework and so on. So I would say that we should not put too much emphasis on the technology as such. So just because the currency is digital, it doesn't mean that that's somehow going to be adopted, universally. There has to be an underlying need, and so it's the combination, I would say, of the need and the technology, which is going to facilitate a currency to become international.
Right. And I like the combination aspect that you just mentioned, because then when I think of China being such a large source of global trade and intermediary of capital inflows and outflows, as they make their currency more international, it would seem to me, just from a logical perspective, there will be greater demand of holding it. So far, we haven't seen much of that, but perhaps the ECNY on a cross-border basis complement that move. We'll have to see about that. Hyun, I wanted to ask you about stable coins. Why can't private sector stable coins solve all the problems that we talked about earlier about the inefficiencies associated with cross-border payments?
Yeah, so this is a very, very good question, and this is a live policy issue, and we had that debate about Libra a couple of years ago. And I think the first point to make is that the currency is a promise of the central bank. So even for stable coins, they derive their value, the stability of their value, from the fact that it is building on the conventional financial system. Right? It is built. The fact that it's a stable coin is by virtue of the fact that it's building on conventional currency. So either bank deposits or government securities, they're holding some assets that back the value of the stable coins. Now, to that extent, you can think of stable coins as being if you like, an appendage of the current system. It's not a separate system as such. Now, the problem, if a stable coin were to take off, is that one of the features of the monetary system is the importance of the coordination effect, the coordination problems that are solved by money. There is this natural network effect where the more people use one currency, the more people want to use that currency. Now, if you have a stable coin, what it does is it fragments that payment system. So it's like saying, we have the currency, which is a promise of the central bank, and it's being used by the commercial banks, and in turn, it's being used by all the retail customers. If you have a stable coin, it's like having another kind of another entity which then has its own closed network. Now, if you can somehow ensure that there is interoperability between the stablecoin and the conventional financial system. So, for example, if you open, your banking app and you can just make a payment to a user of the stablecoin just this way, just in the same way that you could to the users in another commercial bank account, then I think that would still preserve that network effect and the feature of money as a coordination device. But if somehow that stablecoin were to build its own closed network, a walled garden, and it has proprietary information, it uses, it hoards data of its users. Perhaps it's a big tech firm that has a social media business or e-commerce business, and if commercial banks cannot access that information, then that's something which would go against this idea of the monetary system as a coordination device, and it would lead to, if you like, a fragmentation of the monetary system. And it also gives rise to problems that we spoke about at the very beginning, which is about data privacy, about money as a public good, and the importance of having a competitive level playing field. So if you have a closed network, that is very, that's going to undermine this public good nature in some respects, and that to be a user of that network, you have to be a member. You have to, if you like, consent to your data being used only for that network. And there are not the links that will ensure the interoperability. So in short, what I would say is stablecoins, might be okay. They are not a game changer in the same way that cryptocurrencies are, but they may not ensure interoperability. And in that respect, they may fragment the monetary system and go against the public good nature of money.
I think we've seen some of these discomforts displayed by the Chinese authorities in recent years, especially with the Alibaba and Tencent and their nature of those, they're so large and their network are so powerful. And in some ways, the nature of money, from depositing to lending to intermediation, everything is happening within those networks. And from PBS's perspective, I think it was becoming challenging just to keep a track of what was going on, independent of the notion of those guys coming up with their own stable coins. Already it was becoming challenging. So yeah. Question, something that you have touched upon earlier, issue related to data privacy. Will CBDCs undermine that?
I think preserving the safeguards on data privacy will be a very important design feature of CBDCs, because I think it is actually having safeguards on your personal data. This is not simply an economic issue. It is something which is even more basic. It has the attributes of a basic right, and there are some differences across jurisdictions. I think some countries put more weight on this than others, but those are small differences compared to, I think, the main point, which is that there has to be design features which safeguard data privacy. On the other hand, we have to make sure that the payment system isn't just going to be a playground for criminals. So we need to make sure that, just as the current system is, that we have the way to preserve that integrity of the payment system, that we can guard against illicit activities as well. I think this is where we have to go back to that earlier discussion about ways of designing safeguards where no one party has access to the full set of data. The idea of an all-seeing eye that has access to everything about you, your personal details, where you live, what kind of brand of toothpaste you buy, where you had dinner, and what was on your menu, and so on. So that's really a kind of caricature, but that's the kind of so if you like, the limit of that spectrum, where if one party has every piece of the information, you could potentially have this concentration of data, which would undermine this idea of data as a, if you like, a basic right. And so we can take a leaf out of the way that the data privacy issue has been tackled already. So, for example, if I have a mobile phone and I can access a payment network through the mobile phone number, there is no reason why you can go from the mobile number to everything about who you are and what you've done and what you've bought in the supermarket. So if we can keep each of these pieces of information separately and have safeguards, which means that the central bank who is going to be executing these transactions only have access to that piece of data, those pieces of data that are absolutely essential for that transaction to take place, without having all the information that also could be assembled. So the full picture can only be gained by the individual concerned. Only you know what you bought, what brand of toothpaste you bought, what money you have transmitted and so on. For the operator of the payment system, they don't need to know what brand of toothpaste you bought. They only need to know that there was this account that remitted that money to that account. And so we need to design this kind of federated system, if you like, where we each piece of the system has one sliver of the data, so that if you collect all the slivers, you can construct the whole picture. So each party has a piece of the jigsaw puzzle, but if you connect the dots and construct the whole picture, you can get the full picture. But there is no need for one party to have full access to everything. So I think once we think along these lines, and cryptography has really advanced a lot, and so if you like, the power of public key cryptography is going to be a very, very essential piece of technology for us to build on. And this technology has been around for decades. I mean, this is technology that comes from the 1970s, and it's already used in the current system. So, for example, we talked earlier about the open banking system, where you open the bank app of one bank, and then you can check the balances in all your other accounts. That is currently based on the same technology, and so it's just a matter of taking that kind of architecture and making sure that we can preserve privacy all along the way.
Is there a fiscal policy dimension to all this?
Yes, absolutely. And so this is something that we talked about earlier about how do you disperse payments to households, businesses in an emergency like during the pandemic. So if you had these personal details and the account details, you can do that through the banking system. So if you have a retail payment system that is set up already, that respects this inclusive nature, that everyone has access to a bank account, everyone has access to digital payment, you can already do it using the conventional banking system. So there's nothing new about that. The CBDC by itself is not going to change that. It's just another way of building that inclusive payment system. There are some additional features that we talked about, like the programmability. To some extent, they are, if you like, the cream on the top. But I think that would be a secondary feature compared to the universality of access and the inclusive nature of the payment system. And that's already in place. And you can go a long way without having CBDCs. And I would say that, for many countries, you don't need a CBDC to have these good features if you're already, pretty much there.
But Hyun, in the last few decades, maybe in the last half century, we have talked about central bank independence and keeping the central bank somewhat autonomous. But the way you're describing the means of transferring benefits, and it seems to me that monetary fiscal are all coming together. One entity is issuing the currency, the other entity typically is in charge of transfers, but it seems like now it's all together.
I think we have to separate those. So I think we need to think of this very much in terms of the disbursement. So once the political decision has been made, once there has been a fiscal decision to distribute these disbursements to households and firms, then it's a matter of getting the money to people who need it. I think what you're describing is what commonly is referred to as helicopter money, where we can just blur the lines between monetary policy and fiscal policy, and just use the central bank balance sheet to distribute money. That's something that is separate from, I think, what we've been talking about. That's more about the nature of the central bank, the nature of the separation of monetary policy and fiscal policy. So I think that is an issue that would arise even in a conventional payment system. It's not really about the payment system, which is about it's worth bearing in mind that the level of cash, so the amount of cash in circulation, is typically a very small fraction of the total bank deposits. So bank deposits, which are used as a store of value and which are used as a funding source for the loans to borrowers, that's a much larger sum than the cash in circulation. You should think of the CBDCs as very much as digital cash. So we're trying to make the access to cash more efficient. And we should not, over dramatize these other aspects, which I think, it's easy to see why we can sort of over dramatize them. But it is important to bear in mind that those are separate issues that would already arise in the convention system, and they go well beyond the issue of disbursement and the payment system itself.
Well, in a way, you brought us back to exactly where we started from. So it's a very nice look to close. Finally, a bit of prognostication. Your vision for CBDCs 5 years from now.
CBDCs from 5 years from now. So we've made, if we look back 5 years, I don't think many people would have forecast that we would have made so much progress by now. I think so 5 years from now, I would say that some countries will have made a lot of progress towards CBDCs. I think some jurisdictions which are already fairly close will be rolling them out. I think some jurisdictions, they will say, well, we can already achieve most of the benefits of CBDCs, and we don't really need CBDCs as such to reap those benefits. I think it's very interesting to contrast, China on the one hand and India on the other. India already has the UPI system, which is based on Aadhaar, the biometric digital ID. It already has this, these features of universality of access, and the efficiency and the public good nature of the payment system. So there you've already captured most of the benefits. Whereas in China, as you said, that's a very different system where you have the big techs playing a much bigger role, where the public good nature of the payment system needs to be, if you like, reestablished. So countries will go in their different ways. I think we will see, certainly in the wholesale space, much more progress. But in the retail space, in the retail sphere, I would say that you would see a diversity of approaches. And 5 years, although it sounds very long, is going to approach us very quickly. And these projects take a long time, and a lot of it is unrelated to the technology. A lot of it has to do with the underlying institutional changes, and the underlying policy changes, and the political conversations that always accompany that.
Well, we'll look forward to BIS bringing us, or continue to bring us, sort of in the latest views and analysis on this issue for those 5 years that I can't wait to watch. Hyun, thank you so much for your insights. This was a terrific conversation.
Thank you, Taimo. It was a pleasure to join you.
Thank you to our listeners as well. Kopi Time was produced by Martin Tuckey. Daisy Sharma and Violet Lee provided additional assistance. It is for information only and does not represent any trade recommendations or views. All 57 episodes of Kopi Time are available on YouTube and all major podcast platforms, including Apple, Google, and Spotify. As for our research publications, webinars, and live streams, you can find them all by Googling DBS Research Library. Have a great day.